Hi, everyone. A very good evening to one and all, and welcome once again to yet another Edelweiss Connect classroom session. As usual, we look forward to conducting these sessions and connect with you on a monthly basis. Today's topic, as visible on the screen, is called asset allocation strategies and its importance. If you remember, some time back we did a program on 4 steps to successful asset allocation. And at that point in time, there were a lot of queries and questions which came to us even post that on can you tell us about what are the different strategies that can be deployed. And basis that, we thought, let us run a separate program where we discuss asset allocation strategies, in a little more detail, to enhance our own understanding on this very important concept, right? Because as usual, as an investor, whenever and wherever I invest, my endeavor with my investment, with my hard-earned money getting invested, is to get positive returns, right? And I expect that to happen, during the investment journey that I've chosen. But unfortunately, many a times what happens is we may be caught, maybe due to market volatility or maybe some other factor, wherein I am not able to generate that positive return which I expected, right? And hence, the challenge that time comes is, usually I start wondering, what am I doing? Where am I going wrong? And there are too many questions that are running in my head, right? If you want to very simply enhance this probability that we stay, more on the positive side, in terms of our returns, and we generate at least some positivity in our investments during our investment journey, then the easiest and the simplest way by which we can achieve this is by creating some kind of an asset allocation, right? And spread our investments across different investment asset classes. Now, very honestly, whether it's by design or by default, there is some kind of an asset allocation which we have all somewhere done, right? So looking at market conditions, if you think the equity markets are not right, maybe you booked some fixed deposits. Maybe you thought maybe buying gold is also a good option. Maybe you thought of real estate, and then if equity markets look good, you may have perhaps thought of equity markets also, right? So there is a default asset allocation somewhere that I've done, but this is not a design thing, and that's where the problem lies, right? Because then what happens is I evaluate every investment separately. And then, in that whole thing, the problem that happens is, if there is volatility in the equity markets, I start thinking my equity assets are not generating return. But if I focus on net worth, if I focus on my total investment, and perhaps, design an asset allocation basis what my requirements are and some other factors which we'll discuss in the subsequent slides, I may be better tuned into to absorb whatever the market conditions are, and that helps me to stay put in my investment journey and not take any decision which may harm me, in terms of returns which I should have generated had I stayed the course. So we are going to talk about a lot of this, and what we can do in terms of asset allocation and how we can design a very perhaps successful asset allocation which meets my requirements, right? So let's talk about, first things first, on what asset allocation is, right? And asset allocation, very honestly, is simply an investment strategy that aims at balancing my risk-taking capacity and ability, it links it to the reward or the returns that I wish to generate in order to reach for my investment goals, right? For doing this, what I will then do is, basis these 3 factors, I will spread my investments across various investment options. More commonly, Used ones are equity, either directly or through mutual funds, bonds, commodities like gold, and maybe I'll also hold on to some cash if required. And for some, it may even extend to investing in real estate if they have a corpus which can take exposure there. And why do you do this? Primarily because what we've also seen historically is that price movements across these asset classes is negatively correlated. What does it mean when I say negatively correlated? It means that if one is going up, the other may perhaps go down, and vice versa. Right. And so what happens then if I create this kind of an asset allocation, I will see that some or the other investment asset class of mine will generate some positivity, which will then start showing in my portfolio, which will then start giving me better positive potential returns during the course of my journey. So very clearly, I mean, if I am able to create the right asset allocation strategy, it will help me in achieving my future financial goals and requirements. So that's how you need to focus on creating a more focused, designed asset allocation for your own self. If I want to be more in the money, consistently see some positive returns in my portfolio, I need to understand my investment horizon, my time, my risk-taking capacity and ability or requirement, and basis that create an asset mix, which will help me tide over through the investment journey by helping me being more in the positive side in terms of seeing returns, rather than me being more stressed in terms of have I made the right choice, because right now this investment asset class is not generating the returns which I expected. So that's how asset allocation is. If I were to broadly put it into types, there are three broad types: strategic asset allocation, tactical asset allocation, and dynamic asset allocation. And in the next subsequent slides, we'll look at each one of these in a little more detail, which will help us enhance our understanding of what this asset allocation strategy predominantly entails, and how can I use it if I wish to. And post that we'll move towards the importance of asset allocation. So that's how we'll spread our session. Right. So let's start with the first one, and that is a strategic asset allocation. Right. As the name suggests, it's a strategy that you are creating and deploying, and through this strategy you create an asset you create an investment asset mix that will help you steer through different market conditions and reach your future financial requirements and goals. So if I were to just very simply put it, you decide on your asset mix basis your risk-taking capacity, your risk-taking ability, your investment horizon, and your financial requirements, and you stick with it. So it's predominantly a static and a buy and hold kind of a strategy, where you decide on an asset mix and you stay with that, right? And the idea is that I have decided on this strategy, and now this strategy will work in my favor during the course of my investment journey, and so I just stay put basis that decision that I have made. So that's one very simply and one of the most simple asset allocation strategies that we all can deploy is a strategic asset allocation. Uh, how do you do this through mutual funds? Very quite simply, a static asset allocation mix, in a mutual fund, where let's say you're looking at a mix of equity and debt, you could invest in something which is, suiting your investment, appetite in terms of risk and and expected return. So let's say you look at equity debt mix, where equity is higher and debt is a little lower. So you have something, let's say a 65-75% equity and 25 to 35% debt. So this is the asset mix which has been pre-decided, and it's available for all of us to see that this is the asset mix that it will do. And basis this, the fund manager will so this is part of the fund mandate. The fund manager will invest so 65 to 70% in equity, 25 to 35% in debt. So if this is how it has done, so when let's say equity markets rise and debt markets also give you certain returns and the asset mix changes, then there will be something known as a rebalancing, which the fund manager will do. So in mutual funds, in fact, although it is a strategy set, there is an element of rebalancing which comes in, which if you deploy this strategic asset allocation on your own, the big grudge with a lot of people is, that it is static. So over a period of time, it can also get a little more risky because my riskier asset may perhaps, hold a larger quantity and in terms of percentage. And hence, people think that a strategy on over the long term without rebalancing may not be the best way to work on. But the benefit in mutual funds that you can get is, you could invest in hybrid funds. Let's say, at basis whatever your ability, your risk taking ability is, you could have a higher equity, lesser debt, or you could have the other way also if that's how you want to build your portfolio. And basis the mandate of the scheme, there will be a periodic rebalancing that can happen. So that's one benefit that mutual funds give you in comparison to an individually done asset allocation strategy. Because over here, what will happen is you created a strategy and you stick with it, right? Now, the benefit of this simple but very effective strategy, whether you do it individually by creating your own asset mix and then creating schemes within the asset mix, or you take a default scheme, is because you put your mind, you created an effort in deciding on how you want to create the mix. You would want to stick with it, right? Because you would think that, no, I thought through everything. And that is how I've come to this percentage split, right? So, I mean, if you come to a 70-30, 65-35, let's say we are just talking of two asset classes and it's equity and debt, I mean, there must be a basis for you to come to this, right? I mean, otherwise, why 65-35, why 70-30, why not 50-50, or why not 90-10? So then what this very simply does, it makes me believe in my strategy. It has a higher degree of conviction. And hence, the probability that I would make any wrong decision basis, market volatility or situations wherein there is a high probability that I may either become a little more greedy or a little more fearful, are not something which would happen, because you decided that this is a strategy which I have thought through and I want to stick with it, right? So that's one very key differentiation, which you will create, because you would say, yes, I thought of there could be volatility, and that is why I have created a safety net by investing in fixed income. Right? I thought that there will be returns over here. That is why I have allocated a higher percentage of my investments into the equity side. So you'll be a little more confident that you've done this, and you've done this with a lot of thought, and you've designed this, right? And so that is where it really can do wonders in terms of my own belief. One thing which we should all remember is a strategic asset allocation works well over the long term. Right? Because over the long term, what we've seen is, even if there is a degree of volatility, which can occur in our portfolio, specifically on the equity side, in the long term, we've seen the volatility kind of gets ironed out. The risk of investment on the equity side reduces, and it helps me, reach my own investment objectives. So that's where I think a strategic asset allocation works very well, and something which is a very, very important first step to start with. Okay, I mean, there are people who are knowledgeable, who read a lot. So you could either do this on your own, or you could talk to a distribution partner who understands asset allocation and can help you create a diversified investment portfolio for your investment needs, and create a strategy which will help you reach your financial requirements. So this is where a strategic asset allocation works. The next one is a tactical asset allocation. Right now, the big grudge which I told you in strategic asset allocation, it's more of a buy and hold. Right, you do this and you stick with it, right? And a lot of people, kind of find it very boring, mundane, regimentary. That now what? I mean, equity market is growing. But I thought of this strategy, so I'll stick with it. But you start feeling that, can I not take advantage of it? Or the other way also, the markets are a little too volatile. I thought of this as a strategy, but should I just stick with it, or should I do something around it? And that is where a tactical asset allocation very honestly comes in, where now you have an overarching strategy that you set, but you're also open to taking tactical calls. So this involves a little more active participation. This involves a little more active involvement, where now looking at the market situation, you may allocate higher or lower on the equity side, or the other or any other asset class, depending on what you're thinking of the markets. So this gives you a very strong benefit, wherein now you have an overarching strategy, let's say 65-35. Again, let's go back to that as an equity debt, as an investment asset class. But you think that this is a time when equity markets will do well. And, you want to take a little higher exposure on the equity side. So you say, okay, let's do a 75-25 for now, or an 80-20 for now. So you shift. Once that advantage is taken, you go back to 65-35. So you're taking a tactical call, you're taking a tactical bet, wherein now you increase exposure. The reverse of this can also happen, right? You're doing a 65-35, but you're thinking that the markets are going to remain a little volatile for some time, and you don't think that it is perhaps in your best interest to stay invested in the markets during these volatile times. So you do a 50-50 then, you remove 15% from equity markets and you put it on the fixed income side. And, you do a 50-50 that let the volatility tide out. Once the markets are back to its normal curve where it's moving up, I will go back to 65-35. So you again taking a tactical call. So you agree that there is a strategy that you set in place, which is a 65-35 in the example that I just spoke. But you're also ready and more open to taking tactical calls depending on how you are reading the markets. So you are doing a little more, right? So that's how you create an asset mix which will be different from your original strategy during a tactical asset allocation for a small brief period of time, right? And that's how you help in either boosting your returns when you think that the markets are going to do well, or controlling the volatility when you think the markets are in correction mode. So that's how you build your tactics. And if I were to talk in terms of tactical asset allocation, one strategy which a lot of people are now deploying is momentum based strategy, where they are looking at a lot of mutual funds also have momentum based passive schemes. But apart from that also, people are looking at stocks which are carrying some kind of a momentum, where they think that they want to ride this momentum for this short period of time. And during this time, because the stock price will go up, there is a higher probability that with this momentum they will also make some money. So they identify these securities and assign some weights over there which are higher than their strategy, and take these tactical calls. And this is known as a momentum based strategy, which is deployed in a tactical asset allocation. So that's how tacticals work. Okay. And the third one is a dynamic asset allocation. Now you don't have a strategy here. You're saying, no, I don't want to be stuck on a 65-35, 70-30. I want to decide on how much investment I should do depending on how I'm reading the markets. So you're completely open. You think the markets will do well, you can do an 80-20. You think the markets are in correction mode, you will even do a 30-70, where only 30% is in equity, or perhaps even less. right? And these will be adjusted basis on how you're reading the economy, what you're thinking in terms of the broad markets. Are you thinking that the markets are in a bull phase or bear phase? And basis that you are now dynamically managing your asset allocation very clearly. As the name suggests, it's a dynamic asset. So there is no strategy. There is no on that strategy, a small play that you're doing basis, percentage movement. You are totally open and you want to keep it dynamic. You think the markets will do well. You invest higher in equity markets. You think the markets are going to be in correction mode. You invest very very little in equity markets because you don't want to expose your investments to that degree of volatility. Of course, when it comes to both tactical and dynamic, your own active involvement is higher. Your own conviction of what you're doing has to be higher. And hence, there'll be a lot more active calls that you're taking in dynamic, even more so than tactical, because over here you're shifting a majority of your portion depending on how you're reading the markets. Now, either you do it individually or through the help of a distributing partner, or an advisor, whoever helps you. But this has to be a little more actively involved, in comparison to a strategy where you set a strategy and you let the strategy play out. Right. So in terms of mutual funds, there are some mutual funds who work on, pro-cyclical models. There are some who work on counter-cyclical models. What it means is a pro-cyclical model. If the markets are moving up, they will invest more into the equity markets, and a counter-cyclical is the markets are moving up, they will sell and start moving on the other side. So pro-cyclical or counter-cyclical is an approach which works. Apart from this, there are some valuation metrics also which people use in dynamic asset allocation. So there are some dynamic funds. Some will look at price to book, some will look at price to equity, and basis that decide whether their equity allocation should be high or low. So there are different strategies in mutual funds also which are readily available under the dynamic asset allocation window, where there's a ready expert who can help you do a dynamic asset allocation basis what he or she is reading in the markets. So these are how your asset allocation strategies work. Strategic, you create a strategy, you stay on it. Tactical, on that strategy, you're taking some tactical bets depending on how you're reading the markets. Or then if you think that you have spent some time in the markets, you understand the markets a little more, you're open to a little more active calls, then you go to a dynamic. These are three predominant strategies which people work on. And why are these important? Very honestly, the first and most important reason why these need to be, put into place is that, when you have a asset allocation strategy in place, this strategy stops us from exhibiting any kind of an irrational behavior. If the markets are going up, I will not get greedy because I have a strategy. The markets are falling, I may not be as fearful as others because I've thought about something, right? So these irrational behaviors, which somewhere will definitely harm me in terms of my investment journey, are not exhibited by those people who created an asset allocation primarily because they thought through various scenarios. Right? So I understand that, yes, markets are volatile. That is why I don't have 100% in markets, or I don't have 95% in markets. I have 65%. But markets are important because markets also give me that return which generates a higher alpha in my portfolio. So they'll reason out in their own selves and not do dramatic shifts. So you will be stopped from exhibiting irrational behavior by your own self if you have an asset allocation strategy in place. If you're looking at driving your portfolio performance, another thing wherein this asset allocation strategy really helps is because you have spread your investments across various asset classes. The idea of spreading these, like I said earlier also, they may, across these asset classes is because they may be having negative correlation. So if one falls, the other moves up. If the other falls, the first one moves up. And in this, I am creating returns or probability of positive returns across different market conditions. And because they are going to be created across different market conditions, this becomes my best bet, in being more on the positive side than on the negative side in terms of my portfolio performance. So an asset allocation actually helps in driving positive portfolio performance. So that's your second benefit. Similarly, one thing which we'll all agree is, the winners keep changing. Some year equities are damn good, they outperform everything else. You may see some years equities being subdued, gold performing. Some years you may see both of these subdued, maybe fixed income doing better than these. The winners keep changing in terms of asset classes. And I don't know which one will come in the coming years. Nobody knows, right? And hence, my best bet is to take exposure across. Because no matter what the winner is, I have an exposure there. So I am also a winner. So I will keep winning if I have exposures across asset classes. So winners keep changing. And we don't know which one is going to be next. And the last one is, if I do an asset allocation, I can also indulge in something known as a periodic rebalancing. Wherein I go back to my original asset mix. And by doing this, quite simply, I am ensuring that my portfolio is not getting exposed to any higher degree of volatility. And I stick to that strategy which I have set, which I can absorb, wherein even if things are, a little up and down, I am still able to manage, because there is a reason why I have chosen, let's say, a 65-35 in equity and debt, or a 70-30 in equity and debt, right? It's not that I'm not thought through. And because I've thought through, I am comfortable with this percentage. And so to remain comfortable with this percentage, I rebalance. So these are your 4 primary and very, very important reasons to do your own asset allocation. If you can't do it yourself, get in touch with somebody who can help you do it, but create a portfolio which is spread across different investment asset classes. The one question which a lot of us maybe us thinking of is, which is the asset allocation which works best for me? First we need to understand my own attitude towards risk, my own skill. How much do I know? If am I actively involved? Do I know, or do I have to be dependent on somebody to understand what's happening? My own experience in the markets. Markets are very testing. If I'm a first time investor, and markets turn volatile, they can have a series of doubts that I will have in my own self. So in that sense, my own experience to a certain extent, do I have any tools? The easiest and perhaps the first starting point has to be, for a lot of us, is to have a strategic asset allocation. You think of a strategy, you stick to it, right? Then, with a little more time in the markets, with a little more understanding, a lot of people move to a tactical call. No, I'm doing this because I know there is an opportunity that I can clearly see. Then there are some people who think that, no, I want to be a little more dynamic. Who decides this? Very honestly, is obviously your own time, your own experience in the market. But how much of a time and how much actively can you also be involved is also a factor which becomes very, very important in terms of what works. If I understand markets, but I don't have the time to study them in detail and take active bets, maybe a strategy still works best. That I set a strategy and I stick to it. I understand markets, I want to take active calls, then a tactical call over your strategy, or maybe even if you can get fully involved and you understand markets also well, then maybe you can even look at dynamic. That's a choice which you need to make. But first of all, maybe a good starting point is having a strategy in place in terms of how you want to place your investments across asset classes, so that they give you the benefit of the asset class which performs and they being in your portfolio and you generating returns from there. And also it somewhere gives you the cushion of the volatility that the markets have, and you tide over, over that period, and you come out on tops. So this is what I had for all of us. If any one of us has any queries or questions, as usual, I'll request you to please put it in the chat, and we're more than happy to respond to your queries and questions pertaining to our discussion today. Once again, if you have any queries or questions, I'll request you to please put it in the chat for me to respond to them. Okay, it seems that we don't have any questions. I'll still wait for a minute more, just in case you think of something which you want to ask with regards to our discussion on the topic today. And if you do, please last 1 minute, put it in the chat. I'll be more than happy to respond. So there's a question: are there any specific asset allocation strategies for retired people? Thank you for your question, sir, ma'am. Okay. Point is, asset allocation is a very personalized thing. Unless somebody understands your future requirements, your risk-taking ability, your investment horizon, I cannot give you a one-size-fits-all kind of a solution. So in that sense, I would say that yes, there is for retirement people, but it has to be customized. So somebody will have to sit with you, understand what is it that you want to do, and basis that help you design a specific asset allocation tailor-made for your needs. But it is possible, it is doable, and it is being done. So in that sense, there is, it's not about retired people or, working people. Asset allocation is for everybody. So in that sense, if you want to hire safety, if you're talking about, retired people in terms of, low volatility, you may go higher in terms of, non-volatile assets, non-volatile investments, and go lower in the other asset class. So that's also possible. But you'll have to sit with somebody to design a strategy which best fits your requirements. Okay, great. On that note, I think that's all the question that we had. Thank you very much for your time. As usual, it was a pleasure to do this session with you guys, and we will continue to come to you with different topics, interesting topics, topics which help you make better informed investment decisions in the coming months as well. Till then, take care of yourselves, and bye-bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.